Welcome into Storm Stock Solutions. I'm Grant Mercer. It's pre-market on this Friday, and we're here to bring some clarity through the chaos as Wall Street gets set for the final session of the week. Let's start with what's driving the narrative into the open. According to reporting from MarketWatch, Broadcom is front and center after earnings. The headline sounds bullish. AI semiconductor revenue grew 74% last quarter and could potentially double again this quarter. Yet the stock is indicated lower pre-market. That disconnect is classic late-cycle AI behavior. Expectations are sky-high, and even strong numbers can run into valuation fatigue or profit-taking. Traders will be focused on Broadcom's guidance, margins, and any commentary about cloud and hyperscaler AI spending to see whether this is just a sell the news wobble or a sign that AI enthusiasm is bumping into reality. On the macro side, the housing and rate story is resurfacing. MarketWatch highlights that mortgage rates have fallen under the new Trump administration and recent Fed cuts. But Jerome Powell is stressing that lower rates alone won't solve the structural housing shortage in the U.S. Day is a big message. Financing costs are easing, but inventory and affordability are still tight. For markets, this keeps the focus on home builders, REITs, and consumer sentiment. Lower mortgage rates are typically a tailwind, but if buyers still can't find or afford homes, the ripple into spending and construction is more muted than headline rate moves might suggest. Now, in terms of areas of strength traders are watching, there are two interesting lanes. First, the AI platform race. MarketWatch reports OpenAI has rolled out a new ChatGPT model, GPT 5.2, with analysts saying OpenAI is back on top of the benchmarks versus Google. That's not a direct stock, but it's highly relevant for the big tech ecosystem. Microsoft, given its OpenAI partnership, Google, as the incumbent under pressure, and the broader software and cloud complex that depends on AI tools. Traders may not react to the version number, but they will be watching how this shapes sentiment around AI leaders and the competitive gap in generative models. Second, there's a quieter but notable undercurrent of interest around income and real estate as an asset class. One popular MarketWatch piece about families renting and owning investment properties is less about a ticker and more about mindset. People looking at rental income and property equity in a world of shifting rates and uncertain stock valuations. It speaks to an environment where cash flow and real assets are still very much on the radar, even as equities push higher. On the flip side, let's talk about the themes that look fragile and areas to handle with care. Back to Broadcom for a moment. When you see a top-tier AI name deliver huge growth and still trade lower, that puts the whole semiconductor and AI compute space under the microscope. Traders may rotate within the group, favoring names with more reasonable valuations or those earlier in their AI ramp, but it also raises the risk that any miss, even minor, in this space gets punished quickly. Housing is another key risk zone. Even with mortgage rates coming down, Powell's comment about structural shortages means home affordability may stay strained. That can weigh on housing-related retail, big-ticket home goods, and some regional banks tied closely to mortgage and construction lending. Investors will be watching whether rate-sensitive names get a bounce from lower yields, or whether the market instead focuses on the more stubborn, supply-driven side of the story. We also have a bit of company-specific tension in consumer names. Lululemon, for example, is dealing with a CEO departure after what's been described as a tumultuous year for the athleisure brand. Leadership uncertainty layered on top of a competitive retail landscape can make those stocks more volatile on any hint of slower demand or margin pressure. Professionals will be watching whether the broader retail space treats this as an isolated issue or a sign of fatigue in discretionary spending. Now, a few sleepers I'm watching in the background that could matter more if conditions line up. One is the small cap story. According to Lawrence McMillan at MarketWatch, the so-called January effect has arrived early, with the Russell 2000 roaring past the Dow and S&P 500. Historically, small caps can outperform into year-end when risk appetite is strong and when traders start positioning for a broader economic pickup. If that leadership persists today, we could see more rotation out of mega-cap defensiveness and into more cyclical, domestically focused names. It's not a buy or sell call, just a seasonality pattern that often flies under the radar until it suddenly doesn't. Another under-the-radar theme is personal balance sheet focus. Multiple high-traffic MarketWatch stories are about mortgages paid off, rental income, and retirement readiness. That tells you the consumer isn't just thinking about holiday spending. They're thinking about long-term security. Markets tend to underestimate that mindset shift. If households stay cautious, that can cap upside in certain consumer discretionary pockets, even if the macro data look okay on the surface. So as the opening bell approaches, the setup looks like this. AI is still the growth engine but facing a prove-it phase on valuation. Housing is getting some rate relief but remains constrained by supply. And beneath the surface, small caps and real economy stories are starting to rumble as potential new leadership into year-end. You'll be back with intraday updates once the market gets moving to see how these themes actually play out on the tape. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady. Go ahead where you came.